So I was talking about Dr. John Campbell. Just search him on YouTube, and he gives an excellent update on the virus each day. And I'd say he's reading a lot of other news articles. I just look through that, then I don't have to worry about reading 10 or 12 other articles. Also Starbucks just announced its sales were down 4.1%, basically because of China stores being closed, and for at least and possibly earnings down 50% for the coronavirus because of the outbreak. So that's just more news starting to come in. Also, we're seeing that spread in the large, which I talked about. The Russell market now continues to underperform the overall market, and we can see here now we're almost back to where we were over 2 years ago. And it's actually made a new high today as I talk. It's right now down 3.4%. And the SPX, which is the bigger name companies, hasn't fallen to a new low yet in the last week or so, but it's getting close. And then the NASDAQ is about the same as the S&P. That's being held up by the FANG stocks, which is like Amazon, Facebook, Google, Apple, and Netflix, as people go towards those names, thinking they're a little bit more secure. And then going back to, also we're seeing the flight to gold continue. Gold's made a new recent high. It's up to almost 1,700. So that's just telling, just another indicator. The fear index of people investing in gold. And then I mentioned about oil. It's basically crude oil was just 2 months ago was trading up around 66 and was in that about 54 to 65 range, pretty steady. And now we've broken down, and we're getting to prices that we didn't see till back in the 2009 crash. So I don't want to be an alarmist, but a lot of the things that we saw in 2009 are starting to reappear here. Natural gas, it never did, which was low to start with, trading at around 2.4 for a million BTUs. It's dropped all the way to 1.71. So natural gas, extremely low prices. I mean, this is good for the consumer. We should see lower prices at the pumps, but like I say, the whole fracking oil industry, big part of the economy, and we don't know when this is going to turn around. And a lot of that depends on OPEC and Russia coming to some type of agreement, but they don't have the weight or share of the market that they used to have. So anyways, so I did mention, I did actually purchase a company that I thought it was maybe an opportunity to purchase. It's Illumina Biotech company. It has sold off here. Its peak was $375. I bought in here at around $275, $270. It's still expensive. I'm not buying any more. To me, it's like a bit of a Microsoft in the early 80s. It's in the genetic space, and I think it was one of those ones that could hopefully hold for 10 years. I went through some of the financial data on it. Its sales are it's about $3.5 billion company. It's very conservatively financed. Quick ratio, which is current assets, current liabilities is 6 times. You want to see that above 1. Asset coverage is 3,000. You want to see that above 2. Debt holders, the percent capital is only 20. Common shareholders, I should say, common shareholders are 80%, so it's mostly equity shareholders providing financing. And the interest coverage is 21 times. And the returns on invested capital are in the high double digits, 17. Return on invested capital is over 20%, and its owner's earnings are actually $6.95 a share. So, but again, book value to its share price, book value is coming up. They do generate a lot of free cash. Free cash flow last year was almost $1 billion, $842 million. And, but I don't have the price really coming up too much. It depends what multiple you put on it. It's really only growing about 10%, and the PE ratio is quite a bit high, like double that. But I just think eventually it will grow into its valuations. And I'm hoping that I can buy it at a cheaper price in the future also. So they, like I said, they're a global leader in sequencing and array-based solutions for genetic and genomic analysts, and products are wide-ranging. They also make the solutions and all that that are needed for the arrays, and their customers are research centers, academic institutions, government laboratories, and pharmaceutical biotechnology companies. And so their sales are quite spread out. They spend a lot on research, and so by empowering genetic analysis and facilitating a deeper understanding of genetic variation and function, our tools advance disease research, drug development, creation of molecular dynamic tests, which we believe this will trigger a fundamental shift in the practice of medicine and healthcare, and that the increased emphasis on preventive and predictive molecular medicine will issue in error or precision of healthcare. So it's basically, so they have, again, they did come up with a test now for women for checking fetal chromosomal abnormalities. This test is a lot simpler. It's just taken, a blood sample is taken, and then it can be tested, and it's far superior than the old method. And cancer disease is also a genome disease, and they're doing a lot of research into cancer genomics, which is used to identify genomic changes that transform a cell into a cancerous one. And this could lead to a lot of tests for different types of cancer. So they're basically their breakdown in revenues is 20% for their testing equipment, 65% is for consumables, and 15% is for services. So kind of spread out there too. And they have a large community user base where about tens of thousands of papers are available to people that use their services. And it's reduced the cost of sequencing by a factor of 10,000 since 2007. So that's actually quicker. If anybody's familiar with Moore's Law, that's actually quicker than that. Moore's Law said the computer power basically would continue to double every 18 months. But this is actually superseded that. So this is going to be more prevalent in our societies. A lot of people will just get genetic testing and get it. You can actually get it done now and see a small part of your genome. It has 799 patents and 617 pending. So it's going to make it hard for competition to come in, or they're going to have to pay them royalties. They manufacture their products in-house, so they have control of the whole process. Also, just because they're so well known in the community, they spend very little on advertising. And they get very cheap financing to raise their debt. They're doing convertible debt that's almost close to zero, so they have no problem with financing. And they have high internal growth research to acquisitions. So that just means that instead of going out and buying companies, they're actually developing products more in-house. And the ratio of that is 6 times. So 6 times as much money is being spent on research in-house as going out and spending that money on acquisitions. One drawback is that they do have sales in Asia of about 20%. That's one reason I'm holding off now, because next quarter two earnings might be down, and we could see the stock actually probably come down a fair amount, especially with the climate they're in right now. So